Okay, we are live. Wow, we have 6 people already logged in. Okay, great. Hello, everyone. We can just start right away then. Perfect. Hello, everyone. I'm Gayathiri from Index One, and I'm joined by Chris McHeffey and Cmiel from BX. Today, we'll be discussing how to implement tax loss harvesting strategies in modern portfolio management. Tax loss harvesting strategies are increasingly popular in the direct indexing space. And so in this session, we will explore strategies developed by BX that combine approaches from various money managers calculated as indices by Index One. We will cover global, US, and defensive harvester portfolio strategies designed to pursue outperformance while optimizing for tax efficiency. We'll have time for questions after the presentation, so please submit your questions in the chat box as they come up. With that, Craig, could you provide a brief update on BX's innovations in the tax loss harvesting space and how you've collaborated with us at Index One to bring these innovations to market?
Yeah, thanks, G, and welcome. This is such a great opening question because it really kind of goes back to the very beginning origins of BX and Index One. So, in just to take a step back in time, so the first sort of packaged products that came out of the industry were mutual funds, and then eventually people wanted things other than a basket within a mutual fund. And so SMAs, separately managed accounts, became very popular through the 90s and just after the 2000s. And then people wanted to blend things together. And from that was born the unified managed account, or the UMA, where they could sort of blend everything into one account. And then ETFs have become super popular for the last 5 to 10 years, with now thousands of ETFs from passive to active. And then what was born out of that was people that wanted to kind of have the best of all of that really in an SMA. And so those morphed into indexes, which historically indexes have been used for benchmarks or to get plowed into an ETF. But people said if we could actually invest directly into an index, then we can customize it and tax loss harvest it. And so when BX started with Index One 3 years ago, our intent was to create all of our strategies, which we have 65, to be in an index structure or an index wrapper, so that it afforded people the flexibility to customize it and tax loss harvest it. And so BX is does a lot of things other than just tax loss harvesting and direct indexing. But the one differentiator that BX brings to the table in its partnership with Index One is really everything we do is designed to find strategies that outperform their benchmarks. So we're on the cutting edge of bringing both customization, tax loss harvesting, but also outperformance, or we call it alpha for purposes of this conversation. So we just believe that if you're going to go to the trouble of tax loss harvesting, why not also try to get some outperformance relative to your benchmark? And so what Chris is going to walk through are some strategies that historically have outperformed their benchmark in a meaningful way. And also these are all running through tax loss harvesting engines, so that you can capture not only the investment alpha, but the tax alpha. So Chris is going to walk through some examples of that.
Yeah, before I even go into examples of this, Craig, you started by taking a little trip down memory lane and explaining to people mutual funds were one of the first innovations that advisors were delivering. Tax loss harvesting has always been a viable strategy for tax sensitive clients, but let's look at the process by which you did tax loss harvesting back when Craig was a rookie financial advisor. So you'd scroll through your tax sensitive client statements to see where there were positions that were down. You'd get up and go over to the Quotron machine to make sure that those positions were still down. You would do this probably once a year. If they were still down, you'd go back to your desk and physically write tickets to sell those stocks and hand them to somebody. Then you'd make a note on your desk calendar to repeat to buy those stocks back 31 days hence, to not violate the wash sale rule. Now we work with all sorts of powerful technologies that automates all of that. And, it's not just you sell the losers and you buy them back 31 days later. You can still do that. But now you can buy an ETF that replicates kind of what the portfolio is supposed to do to hold your beta, or you can buy a stock that's the most highly correlated to the one that you're harvesting the loss on. Or you can even, some of these engines like AlphaThena that we work with extensively, you can find the stock that would replace the one you sold that minimizes the tracking error versus the intended benchmark as little as possible. So really, really cool innovation. So things that literally would have been impossible to do 20 or 30 years ago can now be done for you, which is outstanding. You can also specify, I don't want to have a lot of $38 losses on my statement, so I want to minimize, I want at a minimum a loss of $500 on every position that I sell, those kinds of things. Just the innovations are mind-boggling, and they really do enable advisors to to much more easily execute what used to be a very, very complicated process. Now,
that's a great point.
Yes, at BX, we do believe there's value in that, and there's particularly high income, high net worth clients tend to be very tax sensitive. A lot of them want to minimize taxes as much as possible. But we thought there was possibly a better approach than simply going to a very fancy system that tries to underperform the market by as little as possible while putting you in a position to tax loss harvest. That to us seems a little bit defeatist, right? So what we set out to do, the investment team at BX, was create portfolios that would be easy to harvest on an ongoing basis because they had a rather, say, substantial number of holdings. If you have a couple of hundred holdings in an account, you're going to have some losses to harvest along the way, but also to maybe outperform the market by a couple of percent, and at the same time maybe take a little bit less risk, right? And that's kind of our mantra on all the portfolios that we build. We always keep a very close eye on correlations of our component strategies that we put into blended portfolios. And what we've created is a series of portfolios designed to be tax loss harvested that deliver outperformance at a lower risk point than a typical benchmark would. So you have the opportunity to generate hundreds of basis points of investment alpha plus your tax alpha that you get from the tax loss harvesting, which really optimizes the outcome for clients. So the first example, very simply, is this US tax loss harvesting portfolio. It's got small cap exposure, it's got mid cap exposure, and it's got 3 different ways of achieving US large cap exposure. And if you put it together, you can turn the page, G. You can see how it did versus the Russell 3000, which is obviously the right benchmark to benchmark it against because it's an all cap US portfolio. And you can see, I mean, we're not showing the statistics, but the downside in 2022 was meaningfully less than the Russell 3000 itself. And you can see that it's generated outperformance kind of over time. Exactly what we try to do when we build portfolios. So G, can we switch the slide? Right, so you can see a slightly smaller maximum drawdown, a substantially higher Sharpe and Sortino ratios, substantially higher performance over time, but at the same time, the beta is 1 and the correlation is 0.98. So basically, you're never going to be surprised on any different given day or month, but over time, you should be able to generate outperformance at the same or lower level of risk, which results in better outcomes. So the second portfolio that we designed is for clients that would prefer global exposure. So we put, large cap international into this portfolio, right? So it's, in a way, it's similar. It's got US small and mid cap, it's got international, and it's got a couple of different ways of achieving US large cap core exposure, which are all designed to deliver outperformance versus, say, the S&P 500. And the results are, once again, really nice. So G, you can switch it. So in this case, we're comparing the portfolio to ACWI because it's a US heavy global portfolio blend. We could have come up with maybe a little bit of a a little bit of a more appropriate benchmark by blending some things because it's a little bit US heavy relative to ACWI, but it's a good enough benchmark. And you can see, the risk management in this one worked really well. That 2022 being down 11, that's better than the US bond market was in US 22 in 2022. So really, really happy with that outcome and that result. So we can turn the slide. So you see, once again, substantial outperformance, higher ratios, and in this case, a way smaller maximum drawdown. I mean, 20 versus 25%, you can feel that in your gut when you're a client. But at the same time, the beta is 1.01 and the correlation is 0.96. So you're never going to really be surprised by what the portfolio is doing on a day in and day out basis. Now, the third different example that we have is a very, very different kind of portfolio. It's for clients who want to remain invested in equities, but in much more defensive equities. So we designed a blend of our strategies, which tend to tilt on the defensive side, that put you in a position to, once again, ongoing harvest the portfolio. There's well over 300 total holdings in this portfolio, but to really protect on the downside while remaining invested. Now, there are some elements here which can get a little bit more defensive and raise cash, but you should have plenty of opportunity to harvest from the hundreds of stocks that you're going to own to offset any gains that you might have from the little bit of tacticalness that's in the portfolio. So G, you can switch turn the slide. So once again, in this case, we're comparing it to the S&P low volatility factor because that's, we think, most appropriate for this particular blend. And you can see that the downside of 6% in 2022 is something most people would have been really, really happy with. So in other words, portfolio is designed to be defensive, and it was defensive at exactly the right time. Next slide. And you can see it achieved that with substantial outperformance versus its benchmark of SPLV. You can see almost double the Sortino ratio. So the amount of upside you get versus the maximum downside on this has been really, really good. A substantial amount of alpha and actually a much lower beta than even the low volatility equity index. So this one's designed to be defensive, just to put ourselves, out there for advisors in a way that not everybody wants to just embrace investing in the Russell 1000 or the S&P 500. Some people want equities, but they want to be more conservative. This is a way to do it and be able to tax loss harvest along the way. So those are kind of the examples that the investment team at BX came up with for tax loss harvesting in an effort to, give advisors the opportunity to produce investment alpha plus tax alpha for their clients, which is an optimal outcome.
Chris, maybe just as a follow-up to a couple of things that you mentioned. One is that BX really thinks the ideal number to have within a tax loss harvesting portfolio is about 350 stocks. So everything that we do is designed to be sort of somewhere in that neighborhood. And the reason for that is because we want to make sure there's things you can actually sell for losses. If you just have 10 or 20 stocks, in a year like this, next thing you know, they're all up and then you can't harvest anything. So we want to make sure that there's enough in there to not only harvest, but also to create diversification amongst styles, as well as create diversification amongst sectors. So whereas one sector might be going up, another sector might be going down, so we can harvest the ones that are going down. The other thing that's kind of interesting is, so many clients that have embedded capital gains. So some people watching this webinar might think, well, this sounds great, but gosh, all my clients are filled to the gills with gains. How do I sell those things and put it into something else? And so what's really interesting about these tax loss harvesting engines, particularly the one at Alpha Athena, is that you can create a capital gain budget. So you can sort of pair your capital gains out over 1, 2, 3 years. Simultaneously, you can be harvesting on the other side of the portfolio and without sacrificing your performance. So we think it's important for advisors to explore what is it that they're trying to do from a tax loss harvesting standpoint, and how does it complement the rest of the portfolio. that's a very different problem than if someone just walking in the door and saying, here's a bunch of cash, can you put it into a brand new strategy? And the last thing I would say is we're not going through any specific examples today on like a 130-30, but those are really well suited for tax loss harvesting, because you're always going to have more stuff that you can be capturing on the loss side. Plus, there's also other things you can do from a protection standpoint. So you might be thinking, hey, the stock market's nearing or is at an all-time high, and I'm putting this money into this new strategy. I don't want to, just naturally go down with the market. And so there are other things that we can do working with CIOs and advisors to add additional protections underneath the portfolio. So anyway, this is a fascinating topic. We could never do it without Index One, not only helping us calculate everything, but helping us ultimately blend those indexes into really powerful solutions. So G, I'll turn it back over to you.
Thank you both so much. We're getting a few questions here, so I'll quickly wrap up and talk about what our role in all of this is. And you just touched upon it a bit, Craig, but I'll just do a quick summary. So Index One serves as the index calculation provider for the BX strategies that we just discussed today. And as an index provider, we partner with advisors and investment strategists to bring innovative ideas like these to life across various themes, asset classes, and factors. By leveraging our ability to design and calculate indices tailored to specific investment objectives, we've been able to help drive the creation of differentiated allocation strategies that power both funds and model portfolios. The BX indices covered in this session are among several indices that we calculate for BX, which are then combined into index blends to meet a range of client investment goals and also to be used in tax-optimized direct indexing portfolios. We're pleased to play a role, as always, in bringing these strategies to market, helping advisors support the client's financial objectives more efficiently while continuing to foster innovation in indexing strategies. All the BX models discussed in today's session are available on both BX and the Index One website. If you have a strategy you like calculated in real time as an index and potentially integrated into other portfolios, please feel free to reach out to us. Great, so let's move into the Q&A portion of the webinar. We've got a few questions here. Okay, Chris. Hi, Chris. Is there a strategy that matches the SPX? Correct, Chris?
So the answer to that question is most of the tax loss harvesting engines that we referred to offer direct indexing and will allow you to try and track the S&P 500. We very specifically don't have an S&P 500 index because S&P already has one of those, and we didn't see much value in creating another one. However, we do have a large cap core index that correlates at like a 0.99 to the S&P that's delivered hundreds of basis points in alpha relative to the S&P. And those are the kinds of strategies that we like to deliver. But yeah, in answer to this question, that it would be easy to find one of those, but it's not one that we're able to offer.
Great. Thanks, Chris. Hi, Elaine. Are you using ADRs and or locals in global strategies?
So the answer to that question, Elaine, is in our global strategies, the particular sleeve that we're using uses US, traded ADRs just due to the difficulty for US financial advisors in executing in local, ordinaries in other markets. A lot of the custodians make that very difficult to accomplish. So we prefer using ADRs. However, we have strategies that we haven't discussed that do trade in locals in case you are offshore or have a preference for trading in ordinary locals. We do have strategies that we could line up to create a blended portfolio for you that use them.
Yeah, I would just say to that tax loss harvesting is such a big thing in the United States and much less of a thing in Europe. So yes, we do have ADR strategies and can do local and currency work as well.
Thanks both. Hi, Abadami. Good day. How are your stocks weighted?
So each of the different component strategies that we put into these blends has a slightly different weighting mechanism. So some of them are weighted according to risk-adjusted momentum, and some of them are weighted according to equal weighting, and some of them are weighted according to other portfolio optimization factors. So every one of them has a kind of a different weighting mechanism, which in a way actually provides yet another kind of level of diversification.
Yeah, that's probably a good time to just reference that, kind of back to the index one and back to the BX platform. BX works with about 22 different strategists. And so each one of them has their own methodology and weighting system. So, and then index one has more beyond that. So, so they're all, the nice thing about it is everybody approaches it differently. And then what we do at the platform level is bring them all together and then blend them into portfolios such as the global tax loss harvest portfolio.
Thanks both. Chris has a follow-up question around fees.
The fees work for these models. The sticker price, we call it, is 25 basis points, and then to run it through a tax loss harvesting engine like AlphaThena, the all-in cost would be 30 basis points. So I don't know, we feel like if you can generate several percentage points over a market cycle of alpha and several percentage points of tax loss harvesting, that's how that works. And those firms through the AlphaThena tax loss harvesting engine, we can pretty much get direct access for clients and advisors at Schwab, Fidelity, Pershing, and other key custodians.
Thank you. Hi, Rakesh. He asks, are there tradable products?
So the answer, I think, to the question is everything that we're talking about today is specifically to everything we're talking about are individual stocks. BX and Index One also have indexes that contain just ETFs. So everything is tradable on the major stock exchanges, and you can either get signals and execute trades yourself, or you can find the different strategies at different tech stacks or TAMPs or trading engines.
Yeah, and I'll also add from Index One's perspective, there are currently 6 ETFs that are tracking our indices outside of the indices that we discussed on this webinar today. But yeah, that's just a little tidbit if you're interested. Okay. And then we have a follow-up from Elaine. What level of losses are you able to harvest in your portfolios?
Elaine, that's going to be really highly dependent on market conditions at any given kind of point in time. We've run some stress testing. We've run our portfolios through a number of different tax loss harvesting engines. I mean, generally, what you see is a few hundred basis points, 300 basis points, maybe in the first couple of years. The one drawback to the tax loss harvesting strategies is over time, assuming the market is rising, there become fewer and fewer losses to harvest. But in those front years, it's not surprising to see examples where even in a good market, you can generate 300 or 400 basis points in tax losses.
And also some variability. So when you go into the tax loss harvesting engine, you can set your loss parameters. So if you want to take more losses, but potentially even smaller losses, you can increase the percentage of losses you might take in any given year. So there's some customization at the user level to determine what your turnover is, which will ultimately play into your maximizing of losses.
Okay, great. Thank you both. I do believe those are the only questions. Well, we'll give it a minute to see if anyone else would like to ask a question. And in the meantime, I guess I could ask one around customization. I mean, you literally just brought it up, but if you could maybe elaborate a bit more on how you can customize these harvested portfolios for specific investment objectives, and how you'd be able to integrate and execute on them as well.
So I think that the answer to that is most of the tax loss harvesting engines that we work with offer the ability for customization in very broad ways. You can customize around single names, around sectors, around industries, etc. The only real use case we see a ton of value in that is, you have heavy exposure to a certain company or industry, and you want to avoid taking on additional exposure to it. Beyond that, like the personal preferences thing is fine, except for at a certain point, the client has become the portfolio manager, and we see a substantial risk in that. And customization is frequently touted as a big advantage of direct indexing vis-a-vis trying to replicate the S&P 500 kind of thing, keeping in mind that our portfolios are designed to produce outperformance versus those benchmarks rather than simply match the benchmarks. It's a further level of caution that we would recommend in using customization, because the more customization you do, the more likely it is you're going to erode the alpha that we've been able to create with these strategies. Craig, did you have anything there?
I would just add to that let's just say that there's two types of users. One is the financial advisor who has a lot of clients and they're trying to use roughly the same strategy across all their different clients. And that can be customized at the financial advisor or RA group so that, this portfolio we're looking at today could be adjusted based on their preferences. At the institutional level is where you would see more customization, where, hey, we really don't want to have any exposure to this industry because our family organization doesn't want to have any more exposure to tech or to real estate, whatever the case might be. So what financial advisors seem to be asking for today is, we would like to be able to customize this at the firm level versus just taking a big box index and consuming it exactly the way that it is. So we lean into that type of customization and really embrace that.
Thanks both. We've got another question in from Elaine. What is the minimum size for client portfolios?
So Elaine, that's going to be highly dependent upon if you're in a full share or a fractional share environment. If you're in a full share environment, we'd kind of have to go through the math to see what's the minimum size that would be, most likely to replicate the model as closely as possible. Obviously, in a fractional share environment, you can really trade any size. But our general thinking is, if you're in a full share environment, $50,000 account, you're probably going to have pretty substantial tracking error trying to hold 350 different stocks versus the model. Whereas a $1 million account, it's probably going to work. The nice thing is that the preference for executing this kind of strategy is generally going to come from those with larger account sizes to begin with. So that's generally not going to be an issue. But yeah, in a full share environment, you're going to need a much larger account for it to make sense. Whereas we're indifferent to it. If you want to do a $20,000 account in a fractional share environment, that's fine. It's just you're not going to realize very many losses.
Great. Thanks both. Okay, and I guess lastly, a question for me, given the current market conditions, are there any adjustments that can be made to any of these portfolios?
Yeah, so we were talking about this earlier, which is, given the market conditions, which have been very strong for U.S. equities for the last several years, for international equities this year, the bond market is having a great year. The question is there ways that financial advisors could execute some of these strategies, but at the same time be aware that, hey, the market could go down? And so the answer is yes. We've created a tool which looks at both the risk of the overall market and the asset allocation pivot points. And so that, as an example, a financial advisor who has a client might say, listen, let's go with this global tax loss harvesting portfolio, but let's wait for the right timing to roll into that, let's say over a period of 3 months or 6 months. Or you can look at this as one sleeve of a client's overall portfolio while you're using other sleeves like our tactical model to balance out the risk if in fact markets are going down. Meaning that you never want to let taxes wag the dog. But at the same time, if the market's going down, the good news, you're going to be capturing losses. But at the same time, you don't want to lose a bunch of money, right? And so that's where we put in our tactical and risk shield components, where you could be harvesting losses and at the same time really managing your drawdowns.
Awesome. Thanks, Craig. Great. I think those are all the questions from our audience. Thank you so much for those questions. I think we had a lovely discussion here. Just to close everything off, thank you everyone for your time and participation. Please be sure to subscribe to our email newsletters to stay updated on our next video content. This happens to be the last webinar of the year, so thank you for tuning in. You'll still see us in one more video content in December, just to kind of, give you all a summary of the last quarter and how markets have fared and how our models are faring against them. But thank you so much for tuning into today's.
It looks like we got one more question popped up on the screen as you were signing off there from.
Oh yeah. Okay. Great. Yeah. Thanks for that. Okay. Do you help your clients reduce a large concentrated position over time and manage capital gains?
Elaine, that's a great question, and that's one of the best use cases for a tax loss harvesting strategy. In other words, your account is half one stock because you worked at that company, and it's half diversified, and that's a nightmarish portfolio, or even 70%, whatever it is. So the idea is to marry the tax loss harvesting strategy with gradually taking the capital gains in the large embedded kind of position that you have. And our friends at Alphathena and Artha and all the different engines that you can execute for the do tax loss harvesting, you can set the parameters on that and say, look, I want this position to be down to 15% of my portfolio within the next 2 years, and it'll try to maximize your, try and make sure the entire portfolio does as closely to the intended target as possible while managing that, eroding of that big position down to a more manageable size.
Thanks, Chris. Okay, I think that's the end of the questions. If anyone has any questions, or feedback or anything like that, please feel free to reach out to us. Our contact details are on screen right now. But yeah, thank you all so much for your time and participation today and all the questions. Thanks for tuning in, and we look forward to seeing you next time. Thanks, everyone.
Thanks for putting this together, G. Bye, all.